It's a challenge to try to answer to this question of what caused the crisis. It's a challenge because already to understand what causes something, like what caused someone to be sick or even to have, even more serious disease, is something extremely difficult because there is a conjunction of sources. For the economic crisis, it's even more complex. I'll try to explain two things, what were the mechanism that led to the crisis that we knew in 2008, and also what's happening after. And for what's happening after, I took it from the angle which we are in here, at least probably very interested in, which is the question of the debt of the European countries. So, I think that should work. Yes. What are we talking about? We're talking of, I put together one over the other, two of the major stock indices. In gray here is the Standard & Poor's index, S&P 500, the most followed index in the financial industry. And in yellow is the Nasdaq. The reason why I quoted the Nasdaq is because, in fact, it had a very strong responsibility in the crisis. The crisis is here. This is the effect of the crisis, this drop here, this cliff that suddenly we experienced. But before that, maybe you don't remember, but it was in 2000. In the 99, there was what we call the dot-com bubble. You had all those companies that were created with valuations that were completely crazy. There were some jokes. I remember one in French newspapers was a concierge in a building who named her dog as a .com, and then suddenly the dog was valued with millions. So that was this totally illogic rise in the Nasdaq index. Now look at the scale. This is not the value, this is what we call a log scale. That means we go to 10 to 100, we go to 100 to 1,000, we go to 1,000 to 10,000. So that means that every increase that you see here represents a relative increase and not an absolute increase. If I put it in actual scale, you will see the spikes completely amplified. So this spike here goes from 1,000 to 5,000 or 4,000, something like this. And then it fell. This drop here between that point and that point represents 3/4 of the value of the index. So that means that people who had invested had lost 3/4 of their investment. And then you see a recovery which is extremely fast. And then this phase here of strong sustainable growth between 2002 and 2007. By the way, there was a little event that happened here, and you see it was politically absolutely devastating. It changed the face of the world, but financially it was just, one little event. It's called 9/11. And it came back, you see? So what happened in here? This phase here was surprisingly enough responsible in some sense for this crisis. And this one changed the way we should look at the economy. So what did I plot in here? For those who are a bit familiar with finance, they know exactly what we call, it's called the credit spread. The credit spread is the following. A spread in finance is not something that's spread, it's a difference. It's a difference between two figures. We call it a spread. That's a financial jargon. In here, it's the difference between the interest rate at which a company can borrow versus the interest rate at which the American state is borrowing. So this is US data. The purple line corresponds to AAA companies, so that's the most secure companies, the companies that are considered are very reliable. Who do we have in this category? You will have AAA, and not so much. You probably have some oil companies, and the next category is the BAA. It's a range of categories that are less reliable. They can be big, they can be small. In both cases, they can be big or small. It's more a matter of reliability. You probably heard of those rating agencies. One of them is Standard & Poor's, another one is Moody's, as the two biggest rating agencies, and they decide who is more or less reliable. So this is an average of the difference. And you see that they are quoted here. So it goes from 0 to 5%. You see that during the crisis, you had a huge loss of confidence, and people didn't want to lend money unless you would post a very high interest rate. However, in general, that was ranging around between 1 and 2% for the very reliable companies, and between 2 and 4% for those. What happened after? You see, the burst of the tech bubble. During the tech bubble, people were putting money, and there was this need for money, so there was an appeal for money, so people were borrowing, and they were ready to borrow at high interest rate. Hence, the rise in this credit spread that you see in here. Then, the burst of the bubble, suddenly nobody wants to borrow because they can't. Credit spread fall, you have this very chaotic period. The 9/11 suddenly, creates a problem. But what happens after? A big decline in the cost of money, a very sustainable and constant decline from 2002 until 2007. And then suddenly, one after the other, the subprime crisis in 2007 and the credit crunch in 2008. This decline, that's what we are going to analyze. That's exactly what built up, prepared all the ground to make, how can I compare that? Imagine a big forest where wood is piling up, at the same time is drying, there is no water, no rain, so wood is piling up and drying. And then suddenly, you just in one match to make the whole forest burn. That's the kind of image that you can have. So what I'm going to describe is what was this dry wood piling up in the forest. One of the elements that we had during this period is the rise of what we call the credit derivatives. So these are complex instruments, which I'm going to describe. Credit derivatives are like options, financial options, but to protect against someone who doesn't pay. It's, in fact, there's one of the biggest credit derivatives are the so-called credit default swap, financially CDS, is in practice something very simple. I don't know, for those who are young, your parents is guaranteeing the fact that you're paying the rent, or for those who are older, it's on the contrary. Your children who want to, as students, need to borrow to rent an apartment, and as a parent, you have to guarantee the rent so that if ever the student doesn't pay the rent, the owner of the apartment has the possibility to ask you to pay in replacement. This is what we call, so protection buyer is the one who needs protection. He will pay on a regular basis. Typically, in the finance world, it will be every year, every 6 months. They will pay a fee. And in case they can't pay any longer, the protection seller is an insurance. It's a simple guarantee. They will, so you borrow money, and the lender tells you, I can lend you provided you are protected. Or it can happen, in fact, CDS usually happen this way. One person borrows money to another. That other person is not so comfortable because this one may default. So the second person will buy protection from a third person, a bank typically, and will say, okay, this one is paying me, I don't know, 6% interest rates, but I'm ready to give you out of those 6%, 2%. So I keep 4% for me. I give you 2%. They tell the bank, I give you 2%, but if ever he is defaulting, you replace, you pay. So instead of having a 6% with risk, you get 4% only, but with much less risk because the bank will take over the loan in case there is a default. In practice, it's very logic that the amount that you have to pay here, so the difference between 6% and 4%, is exactly the credit spread that you saw because it represents the credit risk. So this is one example, of these credit derivatives. And the volume of credit derivatives between 2002 and 2006, I don't remember the exact figure, but it was something like multiplied by 4 or 5. The volume of all the loans that were protected. So, to give you an example. The second class that has been also very much developed is securitization. So securitization is a more complex mechanism. You are a bank, and the bank has as a job to provide loans. It's basically the job of a banker to lend money. So they will lend money for houses, for cars, to student loans, to small and medium enterprise, to bigger enterprise, etc. And the bank, in order to lend money, they have to have the money. How do they have the money? In fact, the bank is doing what we call maturity transformation. When you borrow money from the bank, you borrow for a long period. If it's a consumer loan, it will be, between a year and 7 years. When it's a house loan, it will be 30 years. So it's long periods. On the other hand, every one of us has a bank account. What is a bank account? You think that a bank account is simply, the money is deposited. It's not that. When you receive your bank statement, in financial terms, it is a debt recognition. The bank agrees. You have your financial statement, assume your account is positive. Some of you maybe it's negative, but assume your account is positive. Your account says you have, 500 euros or crowns on your bank account. And so that means that the bank does not have this money. It just recognizes that it owes you this money. And this is money that you can claim anytime. You can go to the bank, give me cash in front of that. It's written on my account, you owe me that. You see? It's not that the bank has the money and it keeps it in a safe. It's using the money. It just recognizes that it owes you that money. So in some sense, the bank is borrowing from everybody money on a short term because people can claim it all the time. and it's lending money on the long term. It's doing what we call maturity transformation. Now, here, the bank were asked for more and more money, so they had to find a different way to finance those loans. That means to get the money. So, of course, one way is to go to the capital markets and issue bonds. So the bank will borrow money from the markets and will lend it to the economy, which is not bad. I mean, it's the functioning of the economy is work this way. How do you make money? How do you assure the market that you will reimburse while you are making loans that themselves are risky? The risk of 1%, and the bank has the statistics because it has thousands of loans, millions of loans that they lend money to people, to small companies, to students, etc. And they know exactly the statistics of the people who statistically, reimburse late or even fail to reimburse at all, get unemployed, etc. So there are periods. Statistics can be bad or good, but they have, those statistics. So now securitization is a technique that puts the bank with much less risk in the following sense. The bank creates what they call a special purpose vehicle. This is a company. This is a subsidiary of the bank. Technically, it is a company. There is no CEO and employees of that company. It's just a shell. It's a company, has a balance sheet. On the one hand, it receives money. On the other one, it has to pay money. So what does it receive? It receives the proceeds of all those guys who are. So when you pay your mortgage, when you reimburse, instead of going to the bank, you pay to this subsidiary of the bank, to the SPV. So it collects all the installments. What does it pay? It issues debt. So that SPV will go to the market and say, okay, I have all those assets which are the proceeds of those loans here. And again, the proceeds, I'm able to borrow money. How I'm going to reimburse you? With the proceeds. So let's take an example. There is 1,000 loans for mortgage, let's say $1 million. Each loan is $1 million. So globally, $1 billion. Those loans, in average, are 6%. So the bank collects the installment of all the loans. Now, it needs $1 billion. So it goes to the market and says, okay, I'm going to borrow $1 billion. They say, okay, the first 700 million will be paid first. So they issue debt. They say, I'm going to borrow from the market 700 millions at much less here, 3%. And those 3%, whatever I collect from all those loans, there might be some default, but you are sure that the very first money that I receive will be for paying the 3% on this 700,000 loan. Then there is a second loan that's coming. So we call that the senior tranche. Then the next 200 millions will be paid with higher interest rate because they will be only coming second. So you have to pay the interest and the installment on this senior tranche. Once this is paid, I use the remaining money to pay what we call the mezzanine, then possibly the junior tranche. And at some point, you finance your billion. You have completely financed it, and you remain with some proceeds. Why do you have proceeds? Because there is a difference. You collect 6%, so even if not everybody is paying, let's say only 80% of the people are paying 80% of 6%, that's close to 5%. And you borrow only at 3% in average, or 3.5%. So you have a big difference, and you collect all that. So securitization is a way to create very secure bonds, bonds that are AAA, even though the population, so I'm the bank, I am collecting, all of you are needing loans, I am collecting all those installments of the loans. I know that statistically some of you won't be able to pay. But in average, there will be a sufficient mass of people who will pay every month so that I can pay out my borrowings. And I collect the difference between interest rate, which when we talk, if you look at the real estate loans, it's close, and what we call the spread is not so big. But when it's credit cards, when it's, a credit card in the United States, they're typically at 20%. So imagine the amount of money that the bank is collecting by doing so. They can afford to borrow money at quite high interest rates. So the probability that the senior tranche is not paid in full is very, very low, except if you have a systemic credit event. What is a systemic credit event? Like we saw in 2008, massive layoff of people who lose their job, and suddenly I was not expecting that half of you cannot reimburse. There I'm in trouble. You see, that's something that is not individual. That's something that represents a huge impact on the market. So, what is the infernal mechanics? The infernal mechanics, in some sense, now you get some type of explanation of the mechanism that led to the crisis. We have to go deep. We have to go deep. We have to go back to the 80s, to the 90s, where we were developing the economy. We were in the afterwar. In the afterwar, you had, people were starting to have fridges and televisions, etc., cars. So you lend to the money, and the economy is booming. Everybody, it's post-war. That's a new growth. And then suddenly in the 80s, we have the oil shock. In the 70s, and then in the 80s, the economy is not so good, so the government decides to induce people in borrowing and also go to the policy of having ownership of their houses. People were renting houses up to the 70s. And in the 80s, they told the banks, so you have to advertise the fact that people should borrow to buy their home and not to own their home and not just to rent it. So in order to develop the economy, you push the market to be more in debt. So you develop credit. Then banks become more and more exposed to credit. So you say, oh, I have a problem here. So I put what we call prudential rules. Prudential rules are rules related to the amount of capital that banks should hold in order to lend. There was, for instance, what we call the Cook ratio. That was the Basel Accords, the first Basel Accords in the late 80s. The first Basel Accord was beginning of the 90s, sorry. It was 90, I don't remember the exact date. It was 92, 94. The second one came in, was released in 98 and became applicable in 2006. So the first one was about credit precisely. If a bank wants to have a global portfolio of loan that she gives, so that money that the bank lends to its clients, in order to lend, for instance, €1 billion, the bank has to hold capital of 8% of that amount. In that case, that means for 1 billion, you need 80 millions. So these are prudential rules. And of course, the prudential rule was saying, but if you hedge this risk, that is, if I lend you money, but I buy protection, like with the CDS that I showed you. I buy a guarantee. Now, I am no longer bearing the credit risk. It's the other establishment, the other bank, who sold the guarantee is now bearing the credit risk. So those 8% is not me who should have it. It's the bank who gave me the guarantee. Now, banks were passing those guarantees to one another and eventually went to pension funds, etc., who were under a different rule because they were not banks. So the prudential rule that were applying to insurance companies and pension funds were not the same as those that were applying to banks. What we call regulatory arbitrage. So the banks started, buying CDS from other financial institutions to reduce the amount of capital that they were needing. And last but not least, remember I told you about this tech bubble. What happened during the tech bubble? You had those venture capitalists who put money in startups and in small companies to help them develop. Those venture capitalists say, oh, there's a new economy, we have to invest huge amount of money, so they put tremendous, totally irrational amount of money in companies that even did not need it. And then they lost this money because the company were valued at a very high level, and suddenly the valuation of the company fell by 3/4. But that 3/4 is the visible part. It's just an average. That's including the Google and the Yahoos. But if you remove those successful companies, the others were more like 90%. So they lost so much money, and they have themselves to report. In venture capital is a fund who is financed by pension funds, etc. And pension funds who are there, they are not speculators. Pension fund, they have to manage the pension of this old lady who's been working all her life in California, in Texas, or wherever. These are pension funds. These are the investors. So those guys were saying, okay, we want to see returns because if you don't have it, we're in trouble. And the venture capital said, okay, well, we'll manage. So they create another type of credit derivative. It's not a derivative here. It's more like a structuring. They call that LBO, I should have put it, leverage buyout. What is leverage buyout? Well, venture capital, you create a company, you start your startup, .com, whatever. And you need to say, okay, well, I'm doing my business plan, and in order to develop correctly, I need $2 million. Okay, very good, you need $2 million. And the venture capital tells you, well, here are $2 million, and I take 30% of the company, and if you need $1 more million, I will take some more of the company, etc. This is a normal behavior. They invest, take part of the equity, maybe they do it partly with a loan, partly with investment in equity, and they develop, you develop your company, they get a piece of the return of your business. In here, they wanted to have cash immediately. And they took companies that were not completely startup, companies that were existing for some time with a good balance sheet, with some profits. And they come to the company, okay, we are going to give you not $2, but $10 million. And thanks to those $10 million, you're going to develop your business like crazy. Okay. And then, so they put money in the company, and they use what we call the balance sheet of the company to borrow. Now they take control of the company, so they are the boss. You're no longer the boss in your company. And they go to the bank and say, okay, look at how my company is profitable. It's been profitable for the past 10 years. So thanks to that, you can lend me money. So not only they put, let's say, 5 million and they borrow another 5 million on the balance sheet of the existing company. The company doesn't need it, but just they borrow. And then they say, oh, I've been so successful, so let me make a huge dividend. Let me take 5 million of dividend out of that, because in fact we don't need all that. So, and they collect the dividend, and that is immediately marked in the accounting rules as profit in the venture fund. So that's, they offset this way the loss that they experienced due to the burst of the tech bubble. But they created what we call leverage, because a company that was not needing debt was suddenly completely in debt. And it had to pay the proceeds of the debt, all the installments, thanks to their balance sheet, their profits. So there was a profitable company, and they made it a non-profitable company. This is the consequence of those leverage buyouts. And then you have had thousands of them during that period. So through securitization, protection, CDS, and there was easy money, and because of easy money, the banks were okay to do leverage buyout, which was absurd. And that made what we saw here, that made those decline in the credit spreads and the rise, because suddenly, economy looked very nice. It was, it was like a very artificial health of the economy. So creation of a highly connected, highly leveraged network. Leverage means that you borrow money against your profits. So you have to reimburse it. And that leads to what we call in physics a metastable equilibrium. Metastable equilibrium, the best known situation, the most common, if you look if you Google it, you will find it's water which is liquid below 0 degrees. So it stays, if you go very, very smoothly below 0 degrees, water may stay liquid, but the slightest perturbation, you put a needle in the water and suddenly the water freezes. Exactly, you see? And the other example is a forest. A forest with dry wood is a metastable equilibrium. Of course, you have a chemical equilibrium between wood and oxygen. And this table won't burst, even though you have wood here, you have oxygen. But I have to put a tremendous amount of energy to burn the table, and eventually it will produce more energy than I had to put in. But the amount of energy is so big that the table won't burn. Now, if you have a forest with dry wood, what happens is that a match, a flash from thunder, or a cigarette, whatever, is sufficient to have the whole forest suddenly burn. So you have, it's in equilibrium, but this equilibrium is metastable. You don't need a big perturbation. The flap of a wing of a butterfly is enough to completely go to another equilibrium between wood and air, which is burned wood. In here is the same thing. So you have this network, all together it holds. But one bank, and Lehman was not the biggest of the banks. It was a large bank, it was a big match, but it was not the largest of them. And one bank was sufficient to destroy the trust between the banks and the whole functioning of all the economy. Suddenly the banks could not lend. So there was loss of confidence and what we can call an inverse bubble. Inverse bubble is the following. Remember this securitization. So here, sorry. Those SPV and the senior tranche, etc. That was supposed to be very secure. And it was sold as such. So you can buy that. There is absolutely no risk. You get your money. So it's like a cash investment plus interest. So everybody wants to say, oh, I want that. It's fantastic. And then suddenly, they discover that there was a wrong incentive that led to frauds. So they discovered, to give you an order of magnitude, when what they call Fannie Mae and Freddie Mac, which are the US government agencies required to reinsure the mortgage loans, those companies discovered that up to 40% of the declarations of people who were filing for loans for their houses were fraudulent. People were posting revenues that were disproportionate with respect to their actual revenues. Up to 40%. So suddenly, they said, well, we don't trust it any longer. Now, they had those loans. Okay, what is a loan? It's something, that's so, the value, suppose that you borrow 1,000 euros, you say, okay, I'm going to pay this interest, and the order of magnitude of the price is about the value of the principal. If you look at statistically, even including the fraud and the fact that people could not pay, maybe it should not be 1,000, but 700, 900 was the order of money that you would collect out of those senior tranches. Even it was really a lower bound determination of it. You could be sure that you would collect more than that. But there was such a loss of confidence that very irrationally, at 25% of the face value, people did not want to buy it. Up to the fact that the government said, okay, whatever happens, at 70%, we buy them. And that's so they saved somehow. That was one of the measures done by the government to save it. And the government made the Fed, the Fed Bank, the Federal Reserve, made a very good investment by buying those products at 70% of their face value. Because in practice, they collected much more money than that. And they could resell them a bit later when the thing was calmed at a higher price. But you had those, this irrationality on the downside. So what is irrationality on the downside? When you have, instead of having too much demand for a product, you have a drop of the demand. And the price is always, it's this determination where you say, the higher the price, the less the demand, and the bigger the supply. And at some point, there is an equilibrium where people are ready. If I'm telling you, okay, I want to sell shirts, if I sell shirts at 10 euros, all of you will want to buy it. If I sell shirts at 1,000 euros, nobody will want to buy it. And there is, at some point, on the opposite, if I'm saying to someone who manufactures the shirts, if I say, okay, do it for 10 euros, nobody wants to do it. If I tell them, do it for 1,000 euros, everybody wants to do it. So the supply increases with the price, the demand decreases with the price. And at some point, you have a price, which we call the equilibrium price, which is the price at which the supply is equal to the demand, so you can feed the market for this. Now, when you have a liquidity crisis, then suddenly there is too much of supply and too little demand. So the demand drops, and because the demand drops, suddenly you have big inventories, you have to sell them, and you have increase of supply. So the equilibrium price drops massively. That creates the liquidity crisis. So it's not something that is due to the actual evaluation of what it is, including the frauds, etc. It's a complete sentiment of the market where nobody wants to buy it, everybody wants to sell whatever they have, and the price can drop to 25% of the face value. Now, okay, let me go a bit fast, but the Minsky financial instability, so you have to know that Minsky should have had the Nobel Prize about 3 times in economy, but they preferred to give Nobel Prize to other people who were saying that everything was fine in the economy. Minsky said, okay, there are 3 types of borrowers. He called them the hedge borrower, the one who, remember what I was telling you about the leverage buyout? You make profit and you say, okay, well, let me borrow, but I make more profits than the interest that I need to pay. In that case, I can pay out my loan because I can reimburse every month more than I have to pay as interest, and in which case, I don't need to. I just, the amount of my debt reduces because I pay the interest plus I reimburse part of the capital. We call that hedge savvy borrower. The speculative borrower is borderline. He just has enough money to pay the interest. So the amount of the debt stays constant, but he just needs, he's borderline. He just needs to, when you have a credit line, for instance, he says every month he has to pull out from the credit line and he's permanently at the limit. And the speculative borrower, the Ponzi borrower, Ponzi was, the Ponzi scheme where, that's, you have the pyramid. The idea is that the guy doesn't have enough money, so he needs to borrow more every month in order to pay out even the interest that he owns on the debt. So you have an exponential increase of the amount of the debt. Now, what is the instability? In a growth phase, you have lots of enthusiasm. So, first of all, people are ready to accept Ponzi borrowers because they think that the business will be so profitable in the future that the gains will increase. Eventually, you will pay out your debt. So they are ready to lend you money even though you don't make money currently. Second, because of confidence, you have lower interest rates. So you are easily in the hedge category. And then you had this increased leverage for instance, with the LBOs. So you have this more and more debt. That's what leverage is, the amount of debt versus the amount of capital. Now, you change and you go to recession phase. You have confidence is destroyed, interest rate go higher, and in that case, what happens is that it's not that the people, that you have, more people who are less reasonable. It's the fact that people shift. They were in this category, and mechanically they fall into this category because interest rates become higher, because the profits declines, and so they were in this category. They were very savvy, and then suddenly they shift to the Ponzi category. And you have more and more of those, and therefore, because they need to borrow, because their profits decline, they borrow at higher interest rate, because also there is less confidence. Then they become Ponzi, so they have to borrow more and more and more, up to the fact that they default. And you have a cascade of defaults. So this is called the Minsky mechanism, the Minsky instability. And this is essential in the functioning of the market. So this is basically this mechanism that occurred when at some point someone said the king is naked, and all those all those borrowings in 2007 was the first announcement was in the summer of 2007 when they said, oh, those very senior secure bonds that you have issued, well, they're not so good. And that created an inverse bubble because the irrationality was about as big as the irrationality on the other side. Now, let's pass the credit crisis and let's see what happened. Normal lending is, now I'm going to analyze a different situation, what Minsky becomes when we talk of governments. Remember, in order to face a crisis, Ben Bernanke was the first one who said, okay, we have to flood the market with money. So he made what we call quantitative easing. Quantitative easing was different folds. The two major folds was printing money by the Fed. The second one was that the American state borrowed massively, they increased the debt massively, and borrowed and gave did what we call the LTRO. That's the technical terms for this buying all the mortgages, loans that were, that all those securitized products that were issued but could not find buyers, etc. So he said, okay, we are not talking here of trying to discuss the cause. We just don't want to repeat the mistakes we did in 1929 that led to the Second World War. So let's first address the immediate need to save the economy. And we'll think what happens afterwards. And that's where we are now in the afterwards. So we have to understand, so suddenly they increased the amount of debt by the state. So what I'm going to show you here is what happens when we increase, when states borrow, which is a very different mechanism from when companies borrow. And I will tell you why it is so different. The first thing is that normal lending, if you put yourself in the shoes of someone who has capital to lend, of a lender, why would you buy bonds? Buying a bond is like lending money. That means that I buy someone, so I give money to someone, and the person tells me, okay, out of that money, I will give you money in the future. So that means lending money to someone, same thing. So the investor says, okay, I want to buy a bond, or I want to buy equity in the business, and the reason for doing a bond, it's a matter of how sure I am, what is my risk in here, what is my expected profit, what is my risk, what is my expected profit, and then finally they says, okay, well, I'd rather lend money for an interest rate that I'm sure about, rather than going into an equity where I'm not sure what will be the future value of the business. Okay. There is a second reason why you want to lend money. Precisely when initially I invested in an equity. I'm a venture capital. I gave $5 million to a company to develop, and then the company is taking some time, the business is not going so good, but altogether it's not a bad business, but it's taking more time than expected, and the company is needing money, more money. And then I can say, okay, well, if I don't help the company, I will lose my initial investment. So let me put some more, even though it is not a very clever thing, independently of everything, to lend money to this company, and the interest rate is not so big, it's also to save my previous investment. So my profit is also make sure that my previous investment will not be lost. So this is a second type of reason for lending money. But when we talk about states, it's a different thing. I call it hiring a safe. if you have, I don't know how much, you can put, a few €100 in your wallet, and that's okay. But if you have €1 billion, what do you do with it? You don't put it in your wallet. You have to put it somewhere. I can put it at the bank, but if I put it at the bank, remember, I'm lending money to the bank. What happens is the bank defaults. So people say, okay, well, let me try to find where, but when you have €1 billion, whatever you do with it is lending it to someone under different contracts, but it's always, so it's not a matter of choosing whether you are going to buy a bond or not to buy a bond. The problem is which bond are you going to buy, but you have no choice of buying one. So it's like what I call hiring a safe. Now, when we are in this logic, that's what we call treasury management, you see that regulation plays a crucial role, up to the point that today, people lend money to governments for a negative interest rate. They're ready to pay the government. They tell the government, okay, I put it black and white on paper, I give you $1 billion, and in a year from now, you're going to reimburse me only 990 millions. Like putting the money at the bank for you and paying a fee on your bank account. That's exactly it. So here we are in a logic that is very much corresponding to the regulation. When the bank says, when the regulator says, okay, if you have T-bonds, then you can lend to the economy. So I will buy T-bonds, a certain amount of T-bonds, because thanks to that, thanks to the fact that I own this capital, I can lend to the economy 12.5 times this amount. So, and this will make me profit because I'm lending it with interest rates which are more profitable. So you see that the logic in here is very different. And you will see it this way. Just to show you the debt of the combined debt of the Eurozone. Look at this is as a percentage of the GDP. It was very constant around 70%. And remember, Maastricht supposedly was 60%. So officially it should be 60%. In practice, it was more like 70%. In average in the Eurozone. Somewhere more, somewhere less. And then suddenly, it blew up. 2012 was here. Today, we are more like at 100%. So governments are in this Ponzi logic. And they increase. To give you an idea, some of you know the ratio in Japan between debt and GDP? %240%. So we have room for growing. Am I right? It's about it? So, and you get the evolution of debt per country. So the black is the average on the whole of Euro in the right scale, and you see, the for each country. Okay. The interest rate instability here is I will go fast here. It's a mathematical model that I drew to explain the evolution of debt exactly according to between the Minsky logic and the relation between interest rate growth, taking the growth as it's like looking at the state as a company, where you see the growth and the tax rate. So it's small model where you also have this logic of hedge and Ponzi, and you finally get a dynamics. And this dynamics is interesting. Okay, I will make it fast, but just want to show you how the dynamics looks like. The dynamics is you have like a limit between the level of the rates and the ratio debt over GDP, where if you're on the left-hand side of that barrier here, the interest rate tend to go lower. If you're on the right-hand side, they tend to rise like crazy, up to the fact that you have a default. So this is, like a line where everything tends to concentrate, and this is the separatrix, where if you're on the left-hand side, you're on the safe side. If you're on the right-hand side, you're on the unsafe side. And if you look at it, this was done in 2012. I didn't redo it, so it was just by the time Greece was defaulting, etc. But that you have this blue, the line where you have to concentrate. What's the difference between the blue dots and the yellow dots? The yellow dots correspond to those, like Denmark, who have control on their currency. The blue dots are those who are in euro, so they can't control their currency. So they are caught in the Minsky logic. And you see that those who have control on their currency, they are basically a bit all over the place. The size of the dot corresponds to the amount of the debt. And those who are on the blue line, they are caught on that line here, just to validate this model that shows, so basically if you are in here, Spain was not so much okay, but if you are in here, you are okay, and if you are on that side here, and Portugal was typically, and Ireland was, those two countries were really in the Minsky spiral. And then once you're in this spiral, when we look at the risk, it's no longer a distribution which is, saying, okay, what is the level at which, in terms of Gaussian distribution of interest rate and what is the risk, etc. Then that's where we are going to the uncertainty on interest rates. That if you pass the critical level, you know that mechanically you are going to jump to a very high level. That's how Portugal lost confidence, had the global financial situation, to be honest, was better than France. But yet, because of this Minsky instability, the interest rate went to 14%. Ireland was about the same. So you see that when the market starts losing confidence, the interest rate can go to very, very high levels. Okay, this is the best explanation which I can give to this absurd situation. The bull and the bear in Wall Street, and the bear is saying. I am, I'm risky, so I want to buy only US debt because of risk on the US market. So, okay, I will go fast on this one. This was showing, okay, well, I will go fast on that. But this is the evolution of supply and demand also. Okay. The infernal logic between central banks, the banks, and the state, where you see that those guys have to print money in order to bail out the states, who bail out the banks, and the banks who help the state because the state have such a big demand that they have to issue government bonds, and who buys the government bonds? Precisely the banks. So you get this very infernal game between the two. And this infernal game, you can see it. Oh. For those who haven't read yet Master and Margarita, this is probably one of the masterpieces of the 20th century of literature. Bulgakov wrote that in 1930 in Soviet Union. And he describes in this little excerpt there's this character who is a magician and creates not fake money, he creates real money. And this money is used by all those ladies to buy luxury goods. And at some point, he clacks in the fingers, and all those goods suddenly disappear. And and then there is his Fagot is the one who is his assistant, and the money said, "What's the trick? What's the magic?" And Fagot says, "There's nothing. It's all plain. You see, the laws of the market, the fact that you see, the valuation of, the confidence. People tell you, well, today it's one value. Tomorrow, yeah, the demand decreased and it's another value. And just the law of the market, it's all plain. So you create money out of thin air. You destroy money. You have people who can become actually rich. They've been lucky. They were at the right place, like winning the lotto. And then suddenly, they thought they were rich, and suddenly they have nothing in their account, and they don't understand. And when you ask them, what's the magic? And everybody in here wants to know what's the magic. And I will tell you, well, it's all plain. It's just the market rules. And it's so well described in this novel. In here, you see, the value of the conjunction between how much you have to insure a bond, so the credit spread, basically, of a bond issued by a bank versus a credit spread of a bond issued by the government. So this is France. And just to show you that it was very much the financial sector, I put LVMH, which has nothing to do. And you see that credit spread through the crisis did not change. Same thing in Spain, it's even worse, because some banks were amplifying, because they were more fragile, so they were amplifying the effect. But it's always the same story. And again, Endesa, which is an energy company, didn't have anything. So just, okay, I want to end on something which was, I was saying, okay, what happens, what's the relation with Europe? And you've seen people saying this big debate between those who say, okay, we should be accountingly very savvy, severe, don't issue more money, and people are concerned about issuing too much debt. And some others, on the contrary, say, okay, why we should, on the contrary, stimulate the economy, whatever is the cost of the debt. Okay. My point in here is about the euro and about another question, which is mutualization of the debt of the different states. A lot of people, so in here I'm knowing the countries that have refused to be part of euro. You can refuse to be part of euro and stay in here. I'm talking about what would happen now that we have the euro, if euro disappears. And you have that tendency, for instance, in Germany, lots of people say, okay, we should have our own Deutschmark because that will be a strong currency, and let all those Mediterranean states deal with their problems, and we have no reason of being concerned by that. Okay, let's see what will happen. Oops. Suppose that one of the major countries, which can be Spain, Italy, even France. France is currently on the, you see that line is on really typically on the left-hand side, so the interest rate in France are going down, even though the situation is not so good in France, it's really going down. So suppose that following one of these Minsky instability, you have a default. Then two possibilities. And we have the question here when they call it the Grexit, the fact that Greece would abandon euro. Two possibilities. one of those big countries will convert the debt into, it's a debt in euro. Investors have bought paper labeled in euro. Now, if you change a paper label in euro into a paper label, let's say in French francs, that's not the same thing. So the investor will consider that as a default. That's very important, the fact that something is considered as a default. So France has two possibilities. Either it says, okay, instead of euro, I'm going to give you a basket with such amount of French francs, such amount of Dutch marks, such amount of blah, blah, blah. And that will be considered. But suddenly, France is exposed to other currencies. It has issued debt in other currencies, in strong currencies. And so it cannot catch up on its economic problem by devaluation of the currency. Or it issues debt into the national currency, but in that case, this is considered as a default. So the debt in weak currencies is, the market will say, okay, all those weak currencies or the Mediterranean currencies are not interesting, so I don't want to buy paper labeled in French francs, in Italian lira, etc. I only want paper in German Deutschmark, florin, whatever. Okay. Then the price of these Mediterranean bonds will fall, and the price on those ones will rise like crazy. That will create a disparity between the currencies. So within weeks, you will see, for instance, the ratio between French franc and Deutschmark multiplied by 2. That's what we are talking about. But what happens to a country? Ask China why they are ready to pay so much to maintain the parity between yuan and dollar. A country, even when it is strong and it has too high a currency, then the products are very expensive, is no longer competitive, and the economy declines. You see? So the first to pay the fact that they wanted to protect and not to support the other half of Europe will be those who precisely, were too healthy, and because they were too healthy, their economy becomes unprofitable, uncompetitive. So we can resolve the Greek problem this way. We certainly will never resolve the problem of France or Italy or Spain this way. There are two big pieces of the euro puzzle. You will get this mechanism in place if you do that. So possible solution, let me end on that. Possible solution is what is unstable is to have a unified currency with ununified debt. Basically, a currency is money issued by the central bank. Debt is money issued by the governments. Thinking that the government and central bank have a complete economic different role is something erroneous. In fact, they are very much intertwined according to this mechanism that I showed you before. So it's very unstable to have on the one hand only one currency, and on the other hand different debts, because then you create this Minsky instability. So on the one hand, you want to say, okay, you say portfolio managers, okay, must diversify, so they have to invest in debt across currencies, and in particular in euros. So in order to protect the demand, no other choice than create what euro bonds, that means bonds issued by Europe. So create a European treasury that now the Germans will say, okay, well, yeah, but we can't do that because this would be very unfair between those who are very savvy in their currency, in their economy, and those who are what we call grasshoppers. So the ants and the grasshoppers. So in here, it's very easy to make a mechanism where you say, on the one hand, Europe borrows on the market, And that money that the European community collects as a whole, the European Union collects as a whole, will be distributed across the different states with different interest rate. If one state satisfies Maastricht, it will have very low interest rate. If one state doesn't satisfy or has completely disbalanced economy, then it will have higher interest rate, but not Minsky, a higher interest rate at a reasonable level. So that's a danger if you selfishly don't address the problem. In fact, the Eurozone now is politically one unit, and if you try to play selfishly, in fact, you'll be the first victim of your selfish play. Thank you.